Today, we're going to look at two separate insurance policies, specifically whole life insurance policies. In this first scenario, we are looking at an individual who is putting in $100,000 of premium per year into a very, very poorly designed whole life insurance policy. This is very much in line with what Dave Ramsey speaks of as far as not being in favor of whole life insurance. So we're going to look at the numbers, and then we're also going to look at the numbers based off of how Replace Your Banker designs insurance policies, and you'll see the vast difference. So in year one, this individual puts in $100,000. They earn zero dividends in the first year, and they also have zero cash value in year one. However, they do have a substantial amount of death benefit. This is a policy that is solely designed for death benefit. So they have $5.4 million of death benefit. This remains to be true in year two. Also, no dividends being paid in year two, zero cash value, and the same amount of death benefit. What you'll see happening in year three is that it starts to accumulate cash value. Still no dividends being paid, but they have 72,000, let's call it, of cash value to work with after 3 years. Again, they've contributed $100,000 each year. So at this stage, they've put in $300,000. They only have $72,000 to work with. Not very appealing. What starts to happen in year four and beyond is they do start to accumulate dividends on the policy, and their cash value starts to increase. Year four, the numbers change quite a bit. They put in another 100,000. They earned 15,000 of dividends in that year, and their cash value is 284,000. Death benefit has also increased to a little over 5.5 million. So when we scroll down, we're going to look at year 10. So after 10 years, this individual has contributed $1 million. They're starting to earn substantial dividends every year that are increasing. However, their cash value is only 936,000, and they've contributed 1 million. And their death benefit has gone up to 5.79 million. This is a very poorly designed whole life insurance policy, designed not for cash value, but designed heavily for death benefit. Scenario number two. We have the same policy in relationship to an individual contributing $100,000 every year. However, where that $100,000 is being allocated is substantially different. So you'll notice a few different things from this design compared to the previous design that we looked at. Difference number one, you do not see zeros in your dividend column for the first 3 years with this design. You also do not see zeros in your total cash value column in the first 2 years with this design. And you also see that the death benefit is substantially lower with this design than the other one. So in short, what we're doing here is we're designing the same policy for a much smaller death benefit and a much higher cash value. So just to recap, this individual is still contributing $100,000 per year. However, in the first year, they're earning a dividend of slightly over $2,000. And immediately they have $76,000 of cash value compared to zero. You go to year two, the dividend that's paid in year two is slightly double from the dividend that was paid in year one. and the cash value is almost up to $160,000 after 2 years. Again, compared to 0 in the other scenario. Now, what you'll also notice is your death benefit is slightly going up every single year. And this also helps to have the cash value increase every single year. So you go down to year 5, this individual's put in $500,000. Their cash value is $490,000. What happens in year 6 is what we call your break-even point, or where you become cash flow positive, which in the other scenario did not happen until year 12. However, in year 6, this person's put in $600,000. Their cash value is $614,000. So they are already earning interest and dividends above and beyond what they've contributed as early as year 6 compared to year 12 in the other design. Now, if we scroll down to year 10 and we compare that to the other scenario we have, this is the big difference. So in the other scenario, we had $930-some thousand of cash value after 10 years, right? So the client had contributed 1 million. They're about 60,000 short of what they've put in. Compared to this, they are 183,000 above and beyond their 1 million. And their death benefit has also crept up from 2.2 to 4.1. The death benefit and the cash value will continue to compound and rise above and beyond the contributions. This is a properly designed whole life insurance policy designed for high cash value and a lower death benefit amount. Much more efficient than what Mr. Ramsey is aware of.